Good morning, everyone. This is Mortgage Post 411. I'm Audrey Boissonou with my co-host Kevin Casey. And today we are joined by Bill Dallas. Good morning, Bill. How are you?
Good. How are you guys?
Good to see you. So a few little housekeeping tips. First, let's make sure that everyone remembers that we have now gone through November 1st. It is NMLS season, people. If you don't have your continuing ed done, you should be a little freaked out. So you go to the mortgage educator's website, you use the countdown as the discount code, and you sign yourself up. Don't forget all the extra states that you still want to be licensed in and get it done. Okay, people, let's just do it. All right. Kevin, anything?
I was going to say most popular day to renew the classes tends to be December 30th for some reason.
Oh my God. That is not the most popular.
Yeah,
That's the best way to guarantee you have no business January 1st, you dork. Oh my
Yep,
God.
I know.
Okay.
we had to cut people. We had to basically cut everybody's use of some software, or just to get them to actually, what? You cut me off of ICE or Encompass or our
Herding
internal
cats,
system,
Bill.
or you can't. Yeah,
Herding
it's
cats.
terrible.
All right.
Yep.
So I just wanted to start on a positive note today, which is the 10-year treasury is at 4.56. Last I looked, that is a marked improvement over last week and the week before and 3 months ago, et cetera, et cetera. So yay. But not to forget that we have a lot of stuff coming up this week still, and it can all go to crap pretty quickly. So on that note, we have Fed speakers constantly. Wednesday, we have Jeffrey, we have Barr, we have Cook, we have Jerome Powell, who's speaking the opening remarks, I think, of the IMF. We have wholesale inventory tomorrow. Thursday, we have initial jobless claims, always a real, so exciting. And then Jerome Powell is going to be speaking at a panel at the IMF. And every time that man opens his mouth, everyone's really paying attention. It moves the market. So do not get complacent. Friday, we have initial job claims. And so it's a wild week, kids. So just enjoy our current treasury index right now. And but be careful. That's all. Just be careful.
I would say if you're going to buy treasuries, now's a really good time to buy them.
Really? Are you giving treasury purchase advice?
I'm just saying, I don't think you're going to see much higher rate than you're going to get right now. And as the rate goes down, the value of the treasury you're holding goes up.
Well, from your mouth to God's ear, that's all I got to say. Just wanted to take a moment and talk about the BLS jobs report, because as everyone knows, it's my favorite. I have often recommended we rename it to the BS jobs report, and boy, was I right yet again. So we're supposed to have 180,000 new jobs created. No, we have 150,000. The revisions in the last 2 months, 110,000, switch the numbers, $101,000. 200,000 people left the labor market just for fun. And we had hit a low in April of 2023 and a low of 3.4%. We're now at 3.9%. And if not for the fact that all those people left the labor market, it would be higher. Okay. So bottom line is we lost 348,000 jobs in October. And we've got reduced hours. So the jobs picture is not so great anymore. It's finally coming to light. What do you think, Bill?
I actually think, you're on to something, right? I think you basically, if you had the scales of justice sitting here and you were trying to figure out, are we going into a recession, or should we, and where are we with interest rates? And so you've always looked at mortgage as this three-stool thing that has to have jobs, low inflation, and really low interest rates. And what we have, or we probably have, jobs now. Jobs have been plentiful for a long time. The economy feels, it's really an odd feel, right? Because the economy feels pretty good, except in our space. Still no listings, still higher rates, volume is down, blah, blah, blah. But overall, there's no credit bubble or no other issues. So I think I'm a little bit where Kevin is, where most of the bond market, I think, thinks that we've probably reached the crescendo of high rate, and now what? And so I actually think the jobs report, unemployment, and really all of that is mixed with this, work the same. It's the COVID hangover. It's work from home. It's where are people? We flushed so much money into the system that we're not sure we're in a recession or not. Well, we're in a recession. It's odd. So interest rates probably, like you said, I think we're probably at the tippy top. And now you're going to see interest rates slowly do something slow over the next year or so. But directionally, I think you're right. I think time to lock in your rates, your high rates, if you can. And then for mortgage, it's hold on, because here we go, right? Rates, I think things are going to get a little bit better.
Well, and just to put a bow on the jobs report, except for July, every single month has been revised down. So those revisions, I have real issues with this, the way they're doing these numbers. And I always have. I've been griping about this way before I knew much of anything. And these huge swings that it causes in the market. And then they come back later like, oh, and literally even years later, it's like, oh, we were wrong. Well, you know what? Don't tell us that something is one thing and then have it be another. And economists are so comfortable with this idea. They're like, oh, well, it would be old data if we waited. And I'm like, old data is better than crap data. So why do we not make sure our data is correct? But that is a whole nother thing.
I think we should abide by the same rule the IRS follows. If the IRS sees a number that ends in all zeros, they call bullshit. Okay. And when the jobs report came out with $150,000 dead even on, like, okay,
$150,000
yes, report exactly as you say it.
Oh my God. Okay. And just another little note, just in case people are seeing the inventory build and freaking out. It happens every year at this time of year. Every year. The average days on the market right now, 21. That is not too much inventory. I don't know if your clients are getting into contract, but mine aren't. Like they put an offer in, 18 offers, 5 offers, 7 offers, and all cash, no contingencies. It's a nightmare out there, people. So this idea that we have too much inventory is a joke. So we have 1.13 million listings. We have 393,000 people in contract. That leaves 737,000 active listings right now. What's normal, Bill?
You're in the 3 million range.
Yeah. And right. In the meltdown, we were at like 4 million and like nobody had a job. So so there you go.
And I think your average time on the market, I mean, that's what I said. Return to normal is, man, we are ways away from that, where you have to sell your house to buy another one. And you might be 90 days on the market or 67 days or something like that. So you've got a lot of, I mean, I know some of your people in the chat, right? Is this a soft landing? Well, I think it feels pretty soft, right? And the reason it's soft is because most people got more money than they've ever had. Savings rates are really high. And if the government gives everybody a bunch of money, I mean, you can't PPP and ERC yourself to, everybody on the planet has a check and has had a bunch of checks and most aren't working. So when you look at it, that part of the market is an anomaly that really is, like, I think, characterizing what you see in data is making the data a little smushy. And I think the Fed has aired on, like it always does, airs on the other side of the pendulum, which is we're gonna constrict for a lot longer. Well, I think they may have reached the final I think adjustments up, which I think is a good thing for us.
Hopefully. And other good news. God, we are just on a roll here with good news, aren't we? All right. So CoreLogic and Black Knight came out with their home price appreciation numbers today. Woohoo! Yes, folks, we are not crashing. What a shocker. And so CoreLogic was up 0.3 and Black Knight was up 0.4 for the month of October. And the home price appreciation for the full year is forecasted for 7 to 8%. So if you were waiting for rates to come down and did not buy a house, good job, because now you're going to pay more, and then you're going to pay some more. So
I think it's the best time. I mean, Kevin, it's like the best time. My view of it has always been, you don't wait to buy real estate. You buy real estate and wait. And I think what happens to people is
Great
they
one.
don't let real estate, don't let the rate deter you from a time when you can buy. And I think, like you guys say, I think now, between now and the middle of next year, listings are going to show up. And if you're a buyer, a real buyer, right, this is going to be good timing for you, because I think you're going to get a lot of subsidy. You're going to get the best rate possible. You can always refinance later. I think the NAR thing, which we're going to talk about a little bit, is interesting. Yep. Right, and gonna blow a hole into the entire boat of the real estate industry. And then I just think if you wait too long and rates drop, what's going to happen?
Yeah,
price is going to continue to go up. I mean,
Absolutely.
and like you said, when I talked to probably Fannie Mae and Freddie Mac, and then almost the entire securitization market in non-QM or other products, and I think, like you said, almost every investor in the United States thinks that single-family residence home values are going to be flat to up over the next 24 months. So, I mean, these are the experts in almost every field, from insurance to financial services to mortgage to banking. So I think it's good news for people.
Here's the problem that we have. It's that the mainstream media is just perpetuating this nonsense that the sky is falling. So there is an article out right now, I think it was by Zillow, correct me if I'm wrong, that says if you buy a house, it's going to take you 13 and a half years to make a profit. 13 and a half years. I mean, there is no calculation that I can come up with that makes sense. Even if, and the example that was done by MBS Highway was, if you're in Cleveland, Ohio, or in Ohio, which is not exactly known for the most robust appreciation, historically speaking, I mean, the math is done incorrectly. And so make sure that we are out there, because there's a lot of people with wrong, bad information right now, and it is our job to educate them, for God's sake, please.
I've gone up against a lot of financial advisors and, oh yeah, you should take your money and put it in the stock market and you'd be better off, blah, blah, blah. And I go, but you're forgetting about the appreciation that you're missing out on in real estate when you do that calculation, because they just do the rent payments versus this, and it's like, and then people won't. Real estate forces you to save money. It forces you to make a monthly payment every month, and part of that payment is you're paying yourself in principal pay down, and you get to ride the appreciation of that home going up. And the financial advisors, they rarely talk about that. It's just crazy.
It is crazy.
Hey, I wanted to go on to, we talked about the appreciation numbers, Black Knight and CoreLogic, and we have a little contest going. Do you want to talk about that?
Oh my God. We are of the same mind right now, because I just found my note. I do that in the beginning, and I totally blew it today. So yes, the crystal ball competition is on for 2023. We did it last year. It was really fun. Our friend Peaches Jensen won by getting not only closest to the number of where the loan limit would be, but also the tiebreaker was the date that they would announce the new conforming loan limits. And lest you be confused thinking that it's already been decided what the new conforming loan limits are. No, kids, all the little boys in the sandbox want to beat each other and tell us ahead of time what they think it will be. So we're seeing that there are new conforming loan limits. Those are not the official Fannie Freddie conforming loan limits. Those will be coming out later. So go to our website, www.mortgagepros411.com, and you can do your entry. And so you say what you think that and this is baby conforming. This is not high balance. So baby conforming loan limit will be for 2024. And the tiebreaker is what date will it be decided? Kevin, would you like to say anything? Make sure it's not.
Well, I will give lots of hints as we go along the line.
Okay.
And it's amazing how many people will guess what the lenders came out with just a few weeks ago. Was it 750 or something like that? And it's like, no, they're being conservative. It's got to be more than that number. Don't go lower than that number. I've had people guess, oh, it's not going to change. I'm like, no, a whole bunch of banks just laid out the money on the line saying it's definitely going to be over 750.
Well, and last year, all Peaches got when she won this thing was a little pat on the head and a little recognition saying, good job. This year, you're going to get free continuing ed online for mortgage educators for next year. Okay. So you can,
Yeah.
Can I play?
So
You
what?
can.
I just put up mine.
Oh, you
There
did?
go.
752, 750, because you got to be a mortgage person. You got to make it so that nobody really can calculate it.
Exactly.
And yeah,
Exactly.
we did a whole talk about that last year and how the last 3 digits are always kind of like a magic.
Okay, I want to ask you two, what was, when you guys started in the business, oh, this is going to be fun. When you guys started in the business, what was the conforming loan limit for a single family?
I don't
Roughly.
remember. I think it was 2 something. I do. It was 1989. What was it in
I think it was
1989?
180 when I got in.
No, it couldn't be because you've been doing this less time than me. What
Yeah,
was
I think you just forgot.
Huh? Oh, I did forget 100%. Okay,
And
somebody
you
come
wanted to
on.
appear younger than me.
I'm so younger than
By
you.
having your value higher, so that doesn't make you look
Okay,
Okay,
like
mine was
Yeah, Bill.
mine in 1980. I started my business in 1980. Was 93,750.
There you go.
What? Oh my goodness. We are dating ourselves.
93,750.
Yeah.
Isn't that
I mean,
amazing?
can you believe that?
No.
Now, I thought, and it was like, whoa. The first house I bought when I moved from Ohio to, yeah, look at everybody put them in there, 93,750. Yes, Jill, I'm old. But I bought a house for 110,000 in Willow Glen area of San Jose.
Oh.
And it was a drug rated house. So
Oh.
I couldn't occupy it for about a month because I had to clean everything out and I had to pretty much gut it. It was one of those 2-bedroom, 1.5 baths with a detached garage, a huge lot for $110,000. And I told my parents it wasn't occupied. And so I sent it back to my dad, who was a school superintendent in Ohio, whose most expensive home ever was $37,500.
Right, right.
He went, what are you guys doing out there in California?
Oh my God.
And if you
I
think
wish you still
today
had that house.
Well,
Okay,
that
when
house
I
is,
started
well, what do you think that house is worth right now?
2.2.
It's somewhere between high ones to middle twos in Willow Glen.
Yeah.
And it's obviously remodeled. It's not much bigger. It looks better.
Wow. Do you
but it's
still
not
own
much
it?
bigger. No.
Oh, disaster. Okay,
But
187.6 was when I started, kids. 187.6.
How much? 186. Oh, you're young.
187.6.
Young.
I was 1989. Yeah. Oh my goodness. Speaking of numbers, I just wanted to mention ever so briefly in this amazing year, 2023, when everyone has broken all of their income records ever. Fannie just posted their Q3 profits at $4.7 billion. That's
Made a little money, huh?
$1 billion in a quarter. That's not year. No. That's in a quarter. So it makes me a little cranky when everyone else is hanging on by the skin of their teeth. And
well, I know they made their money.
What?
I know they made their money with a slow market. All the buybacks.
Okay, Bill, talk about buybacks, okay? Because Bill has a little update on that. Go ahead.
Well, we've worked. Yeah, I've been doing it for a long time, obviously, and I think probably that is one of the worst kept secrets probably in America, right? Is how I've always said that if the agencies said go do affordable housing and go push the envelope here and get more people on, that for mortgage bankers it generally means a prison sentence. And so I think what happened is that they got way out in front. And so two things have happened in the market. One is the scratch and dent market is about 75 or 80 cents on the dollar. So if you have a loss, which if you have a loan that doesn't fit for whatever reason and gets kicked, you're losing a ton of money.
Right.
Not a little bit, because in most cases you're losing the servicing that you sold and maybe you sell it at 95, right? So it was a hit, but not the hit that it was. So I think the MBA has done a good job of going back to the agencies and saying just what you said. You guys are making like $4 billion a quarter. So that's $16-20 billion. And your rank and file are getting slaughtered.
Right.
Not only is volume down, but you're killing us on the other side. And there's no scratch and dent market. So what you're seeing is, I think this is, if you have a loan that you have that's performing, which means it's just making payments,
Yep.
then you're going to be able to indemnify that and not have to repurchase it unless down the road that loan goes into foreclosure.
Okay, just to make
So
sure that we're clear on what you just said. So what he's saying is, if this is a performing loan and you say, listen, we'll back it up later if something goes badly, that indemnify it, then they won't make you repurchase it, which is a huge improvement, right? Huge.
well, what it does is, so companies like ours or big companies, right? You've always managed your scratch and dent. And somebody asked, what is scratch and dent? It's loans that can't be sold to the agencies that now have to go into a market and you have to sell them. And so mortgage bankers can't portfolio a loan because we have small warehouse facilities that don't allow us to keep loans longer than generally 30, 60, 90 days. So if we get one that suddenly we own, we either have to own it in our own cash, refinance it, or resell it to some other investor. And those investors just are, because the rates were so low,
Right.
Rates were 2 or 3, and you're selling into a market that's 8, 7 or 8, you were getting killed with just the rate differential. And then because the loan was a kick from the agencies, you were getting hit from a credit standpoint. And so the scratch is one and the dent is in you.
Yeah.
And so I think for most mortgage banks, it coming on the heels of losing lots of money, trying to lay people off, trying to just survive.
Yes.
Which most just tried to do, companies like Finance of America. I mean, we just gave up the ghost, right? We just said, we're out. We're going to go into reverse mortgage. So people all through this process are just trying to figure out, how can we survive? And then what's that new market look like? But the indemnification allows you to push it and then stay connected to that loan. And if that loan continues to pay, you owe nothing. You just have to measure internally. There's some risk to that loan to you. So like most of us, we have an indemnification pool that we value, and then we have to account for it. And it's generally within the realm. Most mortgage banks probably have a 3 to 8 basis point loan loss reserve that's booked with every loan. So this goes against your reserve, but it's real cash.
Yeah, interesting.
Right to you.
In other news, I heard a little story from somebody I was teaching in an NMLS class. First Republic is calling some of their the lines of credit, the unsecured lines of credit that First Republic had funded, are now being called by Chase. And so it's an opportunity for you guys to reach out to your clients and see, how are they doing? Do they have anything like that? Because they're not wanting to refinance them. They're not helping those borrowers. And so the borrowers are scrambling. So check in with your clients. And another opportunity, just for fun, to check in with your clients is Mr. Cooper had a little, and they're calling it a cybersecurity incident. Okay. They're not saying data breach. They're not saying anyone took.
It was Mrs. Cooper.
No.
She snuck in. She snuck into the back.
Yeah, just a little incident. Okay, well, so they shut everything down, just to be clear. And now they're just starting to unwind it a little bit so that people can start to make their payments. So again, this is important to everyone for 2 reasons. Number one, if you have a client who has a Mr. Cooper loan, reach out for them and help them with this information. Number 2, down the road, if you're running credit and you see lates on a Mr. Cooper loan, look at the dates and see if it's correlating to here, because what they're saying is there should be no fees, no negative credit reporting. But you know how these things go. Occasionally something will slip through the cracks. It'll be some mess up somewhere. So, but again, just to be clear, they're not saying it's a data breach. Their phone number, just in case you need it, is 833-597-8087. So just kind of keep these dates in mind and remember it down the road if you're a client.
Well, and I will pile on a little bit with the First Republic Chase, but let's broaden it a bit for mortgage banks, right? One of the things that when you have a HELOC, which I think to a lot of people is mortgage bankers don't offer HELOCs, right? Banks do. And the reason is the mortgage banking industry is is amortized only. We do not do variable UPB, where the unpaid principal balance moves. We don't service it that way. We don't understand it. The agencies don't do it. You can't sell it. So that's why you see closed in seconds, and seconds being QM, and non-QM really is a HELOC. And so a HELOC, a home equity line of credit, through 06, 07, and 08, what did we learn? We learned that they don't have to advance, and they can call the loan due whenever they want. So you're sitting there thinking you've stockpiled 500 grand of your equity that you can use at any point, and they say it's over. And oh, by the way, we're going to because if you read that document, they can start fully amortizing it at a point, at some point. So you're not only do you go from interest only to something else, now you have to fully pay it. So my view is read the document.
Yes.
Because it is not, and when you look, Figure is probably the one company that's out today that's offering HELOCs to mortgage bankers. And then every mortgage banker has some deal with a local bank, and they're trying to offer customers. So just read the document.
Right.
Could be good.
And remember, they're not a surefire thing, to your point. That's the most important thing. Like, I mean, I think we're all closing HELOCs again, which, how many of us were like, no, thanks. You just go talk to that other person. But we want to maintain those relationships with our clients right now. So, I closed, oh my God, I closed a $250,000 second that I probably made $3 on. Maybe I made $3, maybe. And it took 4 freaking months. It was insane. And it was a good borrower. I just started off with the wrong lender. I mean, please just, and then it all went, to HE double two picks from there.
My
So
loans were like that.
Oh my gosh, just kill me. So anyway, it's
I remember back in 08, how many contractors had tapped in like, $500,000 line of credit, and they were in the middle of construction and they had used the line of credit to do the work. And then it got pulled, and now they're in the middle of construction, and now they have no more access to pay all the work they just had done. And now, so they have no way of paying the other workers and such. And it's like everything just got pulled out from underneath them. And then they ended up going bankrupt because, they couldn't finish the job. They had to pay off the contractors and stuff. And it just was like,
well, and you actually then started with the other problem, which is, what if the bank that I actually bank with or at that time goes under, gets sold? And then they change it and call the loan due.
That's
or have a
here.
different view of it, right? Like with Chase and First Republic, or at Silicon Valley Bank, or pick them, right? A Signature. I mean, and we, so I'm going to go to the higher end of mortgage, is we're suffering. Most mortgage bankers that I work with, or they suffer with the same problem. What do we have, which is a HELOC? We have a warehouse line. And that warehouse line is somewhat the same, presents the same problem to a mortgage banker that a HELOC does to our customer, because it's an annual thing. It can be called at any time. And what happens if Signature Bank goes out, or First Republic was my warehouse bank, or Chase or Wells decides I'm out? I don't want to do.
Do most mortgage bankers have various lines with different banks, or is it one big one with one bank?
You'd love to have one big bank so you could have centralized collateral, and it would make it simple from an operation perspective. But because we've all been through this, hundreds of times, we all have different banks. So you try, and there's this movement to regional banks because they were more, and then regional banks all got crushed. So everybody sort of moved away from the big money centers. So Chase, Wells, B of A, blah, 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 right? And your big six, Citi, and then you move down to these super regionals. So now you just have to be really careful and blended in probably your 2 or 3 banks. But if you're funding $100 million of loans a month as a company, you probably need, and you can keep loans on your warehouse line on average 19 to 20 days, which is generally the average for a delivery. You then need probably 50 million of credit. Most of them have 100 million or of credit that's outstanding into 3 or 4 different banks.
Well, I just want to
And
say
advance rates depend.
ugh,
I mean,
I just want to say thank you to both of you.
by the way, mortgage banks, Audrey, we
Yes.
lose money in warehousing.
I know. I was just going to say thank you to both of you for this little traipse down 2008 memory lane, and my PTSD symptoms have returned. I will, as my heart palpitations start to
you're looking like you're beginning to twitch a little bit.
Exactly. As I am going to start twitching. And by the way, let's just quickly ask or answer. Catherine was asking, Mr. Cooper is First Mortgages from what I know. The phone number was if your clients need to call someone and need some help. And there you go. So let's talk about NAR. I mean, that'll settle us right down. So
that's a big move.
Well, let's just go from the difficult to the really complex.
Sublime to the ridiculous.
Well, so we've been talking about it for the last few weeks, and the feeling was, we always are going to need buyer's agents, and people should be represented. And in California, at least, you've always been able to negotiate a contract, but yet we have a $1.78 billion judgment against NAR and Keller Williams, and what was the other place? There's some other name in there. So I don't know. Have you seen NAR's balance sheet lately? Can they take that kind of hit?
Bob didn't think so. He quit the next day.
Did he quit? I wasn't sure. Did he quit or did he? Was he ejected?
A political move.
What?
That was a very much political move.
I think. Look, it's treble damages, so it's $5 billion. If they actually, so it'll be appealed, but it'll take a while for the appeal. But eventually, they'll lose, right? And how are they going to pay that? So it's going to have to be right. They have dues, they have some reserves, but they're not
have less dues,
they're not
though, aren't they?
They will have insurance.
Okay.
I don't know whether insurance will cover this, but at the end of the day, you saw Redfin. Redfin basically said, we're out of it. We're not going to be a part of NAR, except in Hawaii where we have to be to just get licensing. But so if you look at the big companies, if you take Compass, Douglas Elliman, Keller Williams, and you looked at, I was trying to think who the other public was, Redfin, Zillow, we'll leave them as sort of a techie thing, but Redfin's happy. And anybody like Purple Bricks or anybody who's tried to attack the FSBO market, it tried to work through what I would say would be the incumbent NAR, CAR, Behemoth, right? Which it's just gotten crushed through the years. So this is going to be a big change for mortgage and more importantly, realtors. You and I, we lived through our change, right? Through 06, 07, and 08. And basically the CFPB arrived. And what else arrived? Everybody's a loan officer is now an employee. They have to have a meal break. They have to give a time card. And if this goes into the real estate industry, there won't be, it'll be a fraction of the size, because most people are independent, if not all are independent contractors. And I would say 80 to 90% don't produce at all. One loan a deal, 1 year, one sale a year.
But just like in the mortgage industry, in the mortgage industry 2010, when fees had to be preset, and you couldn't negotiate on every deal, fees went up in general for the industry. It's possible that in the real estate world, the same thing would happen, that, well, if we have to set our fees in advance, we can't negotiate and blah, 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 they're going to be more conservative with their fees. Because I think what started this all is why NAR was, getting people to set their rates and such, is they didn't like individual real estate agents. Oh, wait, we'll cut you a break on this deal. We'll negotiate the feel. And the big companies.
Well, it was interesting that what you went through right through COVID was the largest. You guys correct me if you see something different. I've been doing it since 1980, and I've never had a market where cash transaction was more than 3 to 4% of what I saw.
Oh, It's
ever.
off the charts. It's like a third.
So now you have cash transactions,
Yeah.
which meant vest pocket listings went through the roof. And that kept real buyers from being able to participate, because I want to double dip. If I'm a realtor and I have a listing, I'm going to go sell it to my people, and it's never going to find the market. That's what pissed everybody off.
Mhm.
And then I think overall, the 6%, I mean, when I went to law school, I wrote a paper in real estate. I mean, I didn't know anything about it, but I'd moved from Ohio to California, going to law school at Santa Clara, and while I was running First Franklin. So one of the things I couldn't understand was this duty of care in real estate that's owed to the seller. And I said, well, let's just unbundle this a little bit. So the seller is paying 6%, 3 to 3 on a traditional, and they pay the buyer's agent and they pay the seller's agent. Not really negotiable, although everything says it's negotiable. But at the end of the day, I wrote a paper that said, I don't think any of the buyers really understand that they're not being represented properly by the buy side. Right? Because the seller is paying all the commission. The buyer wants to get a deal done, so they're going to do it. So I just think part of transparency in that was just to try to say to people, hey, and you know, the realtors, to their credit, say we disclose the living crap out of everything, right? We've got 3,000 disclosures. But to the buyer, I don't think the buyers really understood until this market in COVID how they really got hosed.
Well, I'm just going to say, though, that the worst transactions, period, are when there's no realtor for the buyer and it's just the seller. I mean, then we're doing the job of the buyer's agent, because someone's got to look out for those buyers. Someone's got to make sure that everything is what it should be. And that's not happening if there's only one realtor involved. There's no way for it to happen. So
exactly.
Then what?
Well, what I was going to say is, I said, look, let's look at what might happen. Right. So I think there's 3 choices. One, the seller credits. So buyer wants to buy a house. Buyer comes, looks at a listing. Seller provides a 3% credit or a 2% or a 1% credit back in the transaction. And you know how credits go. That's a problem for us as lenders, right? We have all kinds of, did it appraise? What credit? How much credit did we get? It's a pain in the ass, right? So I think there could be a credit given. That's one. 2, the buyer can actually pay the buyer can actually pay for their own fee to be represented and hire a buyer's agent and pay them 1%, whatever, right? So there are going to be companies that are going to do that. And the third option is we figure out how to finance it as a mortgage company.
Okay, so
and we're going to
finance the buyer's agent fee.
Yeah, okay, we'll finance the 3% just like we would a buy down.
Yeah, or just like we finance our own fee.
I don't understand what the difference is. Like, what is the difference? So the seller is paying the buyer's agent, who the buyer picked. The buyer chooses their agent, right? So the seller's paying them. It doesn't mean that the buyer's agent has to do the bidding of the seller. It means that they're there to represent the buyer, and therefore they get paid. And so aren't we just shuffling money?
But don't you think, isn't that a conflict? I mean, I don't think the buyer knows that it's a conflict. And that was my point, was conflicted.
I mean, you know,
well, if you owe my point has always been that it's a little bit of a cartel. It was hard to, and what happened what I said actually started this, I think the little crack in the dam was really started when the NMLS was democratized and everybody had access to CoreLogic and all this other listing data.
NMLS or MLS?
MLS. Sorry. The MLS was democratized,
Yeah.
and the MLS then became available. So you and I could actually click on a button in Zillow or someplace else. And there's all kinds of, everybody's got a listing access, that's now mobile.
Right.
And then and I think that started the process, because once that became less cartel-like,
Yep.
everybody had access to it. So then it's like, okay, I'm looking for a house all the time. I'm always looking at houses, right?
I just think, okay, so I think it's a slippery slope, frankly. So all of a sudden, realtors are bad, their commissions are outrageous, and how dare they? And they've screwed everyone. All right, walk into a surgical room, a surgery at a hospital, and you tell me that surgery is actually worth $1 million. Okay, break that down for me, and you tell me that for a health situation, that it's okay to charge someone $1 million to save their life. Explain. How do you say that an attorney is worth $1,200 an hour? How do you say? And so, you know what I mean? Like, what are we doing with this? I'm just a little.
Well, industries, I think you're right. I mean, I think industries like, you go to England, or you look at other English speaking markets, which would be Australia, New Zealand, probably England, right? And then any of the Commonwealth countries. All of those countries, the average fee, right, is 1 to 1.5%.
Yep. Just sold a place. It's like, wow, it costs nothing to sell it.
And I think here it's just, so is it worth it? I mean, like I see, I'm reading just some of the comments, and yeah, I mean, I think my point would be, if I gave my daughter to, let's say, Jill, and she's a former realtor, and I gave my daughter to her, I want her to represent my daughter to buy a house, right? And my daughter believes that Jill is representing her, but because she's not being paid by my daughter, right, there is no real contractual agreement. Although you could, when you read through all the disclosures, it somewhat tries to disclose that this is a dual agency thing, right? And they try to make it, so they've done the best they could to try to say 3 and 3. The point is, legally, all the duty of care is owed only to the seller, not to the buyer. Read it, right? It's in the law. So you have a fiduciary duty to the seller and not to the buyer, which means only weird things could happen. So
I just renewed my.
I just want to make sure that there's an opportunity for us, because I think
so too.
Realtors, there are going to be less of them, which is our referral source. And then they're going to need to finance this, right? Which is an opportunity for us. Yeah. And I got a feeling with the law changes, you're going to see more realtors mortgage things become one, which is exactly how I started at Dallas Capital. Dallas Properties and First Franklin was one when I started. And I sold property, I did the loans. Right. And I had to disclose it, that I was doing both. Same. Right. And then NMLS was created. We had the BRE, then we had this DFBI. I mean, it's like we've gone through 50 ways to try to figure this out, and yet we're getting closer in California, especially, to where the same license would enable you to be able to do both all the transaction. Which, is that good? I don't know. I think so. I mean, there are some reasons why you'd want that, and there's some reasons why you wouldn't.
I've just renewed my DRE, Department of Real Estate's license. I have never sold a single piece of property. I just had it because I started doing loans when dinosaurs walked the earth. So I maintain it because it would just be much more of a pain in the wazooski should I ever need it again. And I definitely read, as I was reading every single word in that manuscript that I studied very, very seriously so I could get through it, that the realtors really do owe the buyer I mean, there's a lot of care that they're assigned, and the seller does owe something to the buyer. And so if that's not happening, then they're violating whatever they have agreed to be and do as a
In
realtor.
any other contract, you got me in law school, right? In every other contract, there's a complete adversarial relationship between the buyer and the seller.
Okay.
Right. Not
right.
But
And it's
that's-
contractual. It's brought together. You talk, I mean, if it's an oral contract, I say, I'm going to do this for you. If it's written, right, it has to go to another level. But at the end of the day, there's consideration paid. Everybody knows, and transparency is to make sure that each party knows who's representing whom, and then on the flip side, who's getting paid, because who pays you to do what generally creates the issues. Right.
But
yeah,
and
I have to throw this.
And mortgage people, we're just sort of in the middle playing whack-a-mole with both sides of these guys, and then we throw stuff at them like, oh, you know, we got to do an appraisal, or oh, hey, let's take a look at this inspection report, or oh, you know, we just start throwing little darts at the compliance part of the deal to protect who, though? We're protecting the buyer and the seller, even though they don't think. They think we're trying to hose them when we cut the appraisal or we do something, right? It's just.
Well, if you ever done a for sale by owner and there isn't a real estate agent in the deal, so it's an individual buyer and an individual seller trying to do it, and you're trying to do the loan, you might as well just give up, because a deal will
never. And that was, I mean, if you're Open Door or your Home Pie or your companies that are Purple Bricks, or you're these companies that try to power FSBO, for sale by owner, right? They've never taken on. Right. And I would say, like you guys, I actually think we do more. One of the reasons why I got out of residential real estate and into mortgage was the mortgage was the most important part of the transaction. Yep. It powers every transaction. I can do more of them, right, than just a listing at a time or a sale at a time. And so it was a way, I think, to not only protect the buyer, but I enjoyed trying to put the deal together.
Yeah, me too.
The structuring of a transaction based upon the complication of not only what the seller's property presents, but the buyer's income or assets and all other issues is just, it's mind numbing, but it's also fun. I mean, it's really what we're good at. And so I think it's just going to be a huge opportunity for mortgage.
Yeah.
And I'm a little concerned about what this means for our number one referral partner to just get what, I mean, this is like tobacco. This is like lead paint. This is at that level. I mean, you haven't reached to the hundreds of billions of dollars yet, but when they're done with 50 states or they start doing that, I'm not sure where this goes. But for us, I think our number one referral partner is in the penalty box.
Yep.
Right. Well, I'm just going to say, if somebody is a realtor who is doing one transaction a year, they're not really a referral partner. And I am ready for all the people who are not professionals in both mortgage and real estate to be gone. Like gone. Go away and do not come back. I'm just
I think the market's going to create that, going to help you with that one.
Yeah, but Bill, they come back. It's so annoying. God, I'm so sick of it. Okay, we're going to run out of time, for God's sake. I told you about what?
I told you we would.
I know. Okay, I want to talk about equity shares. We touched on it last time you were with us, and I had to think about it for a while, and now I have to some extent. And now I want you to take a dive into it again. Tell us why this is a good option.
Well, there's record equity in the United States, right? We've never seen anything quite like this. So first of all, we have record equity. If there was no equity, I wouldn't even be talking about it.
Okay.
So that's fact number one.
Yep.
Second, and record equity means there's so much equity that, and forget above 80%, there's another 20%. So any number you see about equity has another 20% on top of that.
Yep.
And then I think there's two types of customers. There's mass, what I call M&A, mass non-affluent, and affluent. And the unfortunate thing about mortgage over my history is the mortgage business is built for M&As. It's built for people that need down payment assistance and have income. And then they have very little assets most time, right? It's first time home buyer, blah, blah, blah.
Yep.
So that group is over here with income. Well, there's a whole group over here who are affluent and have a lot of equity and can't pay. So my view is, like we do in reverse, give people a payment option and a non-payment option. And we should do that. And so HEI contracts, these home equity installment, the industry is going to be called HEI, which is home equity installment contract. So it's an HEI is the abbreviation. And HEI is suddenly going to be an equity share or some form of an equity share with the homeowner with no payment. So it's going to be very simple. Now it's expensive because there's no payment. So you're going to pay more than you would on a normal second, but you're not going to have any payments. So if you were going to pay 10 to 12% today for a second, you'll probably pay all in 15% to the investor who's going to sit there and wait for you to sell your house as a partner, but you're going to get the money. So you're going to get $100,000 with no payments, and you're going to share more of that equity with that investor over time. And that business is going to blossom because there's so much equity in the United States.
Okay, so I'm just going to take a second here because I am going to be put in the penalty box because I did not mention that we had a speaker last week, Katie DeLasto, which will be it. If it isn't, it will be on our YouTube
Coach
channel.
Katie, go listen to Coach Katie.
Yeah, she's great. She talked about the fundamentals.
You think I talk a lot? Wait till you get Coach Katie on here.
No, we are.
She and I would
last week. So with that being said, we have people who are saying that we should do this more. I've never had anyone go, oh my God, this wasn't long enough. So this isn't long enough. Holy moly. So it will be on our YouTube channel, Mortgage Pros 411. Make sure that you share it, spread it, etc. So Bill, okay, so who figures out how much this is worth for the investor who puts his money in, to make up the equity share?
So same as you will use an appraisal. So it's very simple underwrite, right? It's an appraisal. So we're trying to figure out equity. If you follow, go check out today. There's Unison, Home Tap, Digital Point, and maybe one other one that all do this online. So these guys are all fintech companies today that are offering HEIs direct to consumers. There's no mortgage bank playing in this today because most of our challenge is this, I mean, if you talk to your lawyer, your compliance lawyer, it's like, is this a loan or is this what is this actually, right? So we have, and I could send you all or send it to you too. You can check all. So first it's got to be rated. So for securitizations to actually raise any money with investors, other than one loan at a time, you've got to create a market for it. So what I've been doing is working with a company called Equify, which is based in San Jose. And I'm working with them because they're experts in insurance and they're experts with these investors to help create this market for mortgage people. So we can play in it. And that's basically, instead of offering a high price second with a payment, and you have to qualify, and maybe you qualify, and maybe you don't, is here's an equity share option. You have no payments, and then just good luck, right?
So, okay, so we have a comment here. Big problem with these equity sharing loans as your client can never refinance. So
client can refinance anytime they want. Yeah. Okay. There's no prepayment penalty. If the client refinances, they pay off the equity share and they get a lower rate.
Okay, so they do have the opportunity to pay off the equity share at some point?
Yeah.
Anytime.
Okay.
Anytime. I mean, it's just the commitment on the other side, and there's a cap. There's a max cap. The other thing is, what if, I want to get off of it, I do an equity share, then I win the lotto, and I want to pay off my loan today. Well, look, you don't have to keep the loan for the 10 years, and you don't have to pay this massive amount. It's ratcheted back to how much you've used the equity share mean, it's thoughtful that way, and if you read, Morning Stars or DBRS, or you read any of the rating agency information on it, all the challenges that you guys are going to put in the webinar chat are all in there in terms of discussion. Most of them came from reverse. So the reverse industry sort of gave this industry its legs. The cool thing about this is you don't have to be over 62. You can be at any age, right?
So how is it different than a reverse mortgage then?
Well, there's no payment, and there's no note, there's no ratcheting. It's not a reverse is basically a negatively amortizing equity HELOC, right? Where there's a coupon and it's building, and then when you die, you basically slide it. This is one where you own it. A partner just comes in beside you, and they sit there and wait for you to sell your house.
Right. Well,
Now,
and someone made the comment,
what if
if they don't have sufficient income, but I mean, if they don't have sufficient income, they don't have sufficient income. That's, I mean, it is what it is.
Most people, right? They don't need the income because they're not making a payment.
Right.
Right.
There is no sufficient income. The issue is the only issue for mortgage bankers is they really don't understand it. And it's more, I want to be clear, it will end up being more expensive than a second, but you have no payment.
You have no payment.
Right? You have no payment. This only appeals to, I liken it to the way I sell it is you have two customers. I have an income statement customer who actually has a job, a good one, and can afford things. And then I have people who have assets that can't afford things but own a house.
Right.
When this person needs money, right, and they can't afford it, it never has made sense to me. Okay, you have bad credit, you don't have any income, so I'm going to increase the rate on you and really make this extremely hard so you never pay.
Yeah.
The other thing to think about is this partner is alongside you. They want your house to go up in value. In fact, I would actually say that if you start stumbling on your first, I would say the first partner to maybe help you might be the owner of this of the rest of the equity, because they want your equity to go up, not down.
So it sounds like there are differences between these different companies who are doing these, and
it's like the wild west right now.
It's the Wild West
in securitization.
Okay. Is there someone here who's putting comments in the chat about what a nightmare she's got right now with one, and it sounds like her borrower's stuck, but would they be stuck anyway? I mean, that's the question, I think, right? Like, I
think the same thing that I'm working on with, I think to their point. So if you go to Unison or Home Tap, or you go to one of these companies, it's a 12-year-old call center person talking to a customer who has a very complicated financial situation, or there's a deal, right? My view of this is I've always said this needs to be to the pros, each of you. We need to put this with the pros who actually are protecting our consumers, understand the business, understand the complications of every transaction, because it isn't that simple.
Right. It's not simple.
Right.
Yeah, I had one the client came to me like that. It was complicated. What we ended up doing was just doing a DSCR loan, because
and I think what's cool about this is you've got, what am I doing with the equity? Well, if they did maybe they put an ADU on their property. Maybe they're adding more income. I mean, I think these are, look, we've all learned everything that we need to know about agency and all these stupid guidelines. We've all learned everything about reverse and all those stupid guidelines. You need to learn about HEIs. And I can spend time. I'll send to you two, information so you can sort of begin to help everybody lean into it. And it's not going to go away, because I think insurance companies, the challenge with the market today is that as interest rates have gone up, you can, as an investor, you can get a lot of yield and don't do much.
Yep. Yeah.
And most times to get a higher yield, you really had to take some risk. So this is a way for insurance company investors, and most of my investors who invest in reverse are insurance companies. This is a way for them to get exposure to single family residences, and they don't have to worry about Fannie Mae and Freddie Mac and repurchase requests and all this other crap that we learn about. All they have to do is put money to work in single family residences, which are very safe, and there's no payments to collect.
Right.
Right. I mean,
Right.
how let's figure out, how do we service these loans?
So Bill,
Yeah, I was
is
gonna
it really
say.
worth 15%?
Sit there and go, wonder if it's
Okay,
ever going to pay off.
So apparently I have a very bad habit of saying that I'm going to send something to be embedded in our YouTube channel to our YouTube guy, Jason Bellevue, who so kindly does this out of the goodness of his heart. So you're going to send me something, just to be clear, that
Yeah,
we are
I'm
going
gonna
to
send you a
embed in our
deck.
YouTube channel, right?
Yeah, that gives you sort
Okay.
of the investor view, which I
Okay.
think is the best way to learn about it. Like you guys, you learn guidelines and rules. Okay, let's learn some guidelines and rules about
Yep.
HEI contracts.
Okay, and so
Right. And
what's the typical share of equity, and can you do it as a how does it work? Like, well, and quickly, we're low, so
And
out
we're over time
yeah,
here.
so normally you can go up to 80%, a little less, 75, 80%, in reverse, it's 65, right? But you can go up to, let's say 70%, and you keep your first, which everybody wants to do suddenly. And we give you, and we're sharing, we're going to give you cash, and we're sharing in the equity above a certain number. That's it.
All right.
And it's
so
capped.
It's
The max
it's complicated. There's no easy answer that's going to happen today.
No.
You're going to send me
That's very not
something that
complicated.
we're going to embed it in our YouTube channel, and there will be a phone number to call, or like, what are we doing with that? You'll give me contact information. Yeah.
Yes.
Great.
Yeah.
Okay. Wonderful.
And I think the cool thing about it for mortgage bankers is that it's another big arrow in the quiver.
Yeah.
Which helps you with customers who fall on this side. If I have low FICO, I don't have any income, right? Or I have low income and I have a lot of equity. How would I take that out in an advantageous way to a consumer? It's almost impossible.
Yeah.
In our structure.
Well, and we've got a comment here: as a CPA broker, you'll have potential litigation from heirs of parents because their equity was perceived as stolen, and that's a bunch of baloney. I think
it's not stolen.
There's so much.
They gave it to you.
There's so much that goes.
No, the equity is still there.
Well, yeah. but also on the reverse side, I mean, you go through so much to make sure that everyone understands what they're getting into. That at some point, yeah.
It's a
okay,
loan. It's different.
Just before we go here. Breaking news: Farmers is pulling out of California on the insurance industry.
All right.
Well, hopefully not all the farmers go, because we got cotton and other things we got to pick.
No, I mean farmers
like
insurance.
If it's just the insurance guys, I'm okay with that.
Oh my God. All right, kids.
Nobody left.
Listen, we know that's not true. Go listen to the insurance.
Thank
we
you,
did
guys.
a whole thing on insurance. It's on the YouTube channel with Joe Weber. And it explained how
I like that farmers insurance.
We have admitted carriers, we have non-admitted carriers, and the non-admitted carriers are really picking up the slack. So go listen to the YouTube, and we will see you next week. And I will
thank you guys.
Love you. Thank you so much.
Love you guys.
Bye, everybody.
You,
see you later.
Appreciate it. See y'all.
Bye-bye.